I think that's a great place to dig a little bit deeper now, because we are just throwing around this kind of generic term non-QM, and sometimes I think people don't know what it means. Sometimes maybe they think it means just strictly non-agency, but that's not what we mean either, right? There's a lot of nuances to non-QM once you get into that type of product. So let's start with just what is non-QM by itself?
Yeah, and that's a great point, Jeff. And I'm going to start by talking about a QM loan first, and then come back around to non-QM. So after the financial crisis, Dodd-Frank came about, and they set a condition in Dodd-Frank of quantifying loans as a qualified mortgage or not. If you were a qualified mortgage, that effectively meant you had the backing of the U.S. government, right? Like you're going to get a guarantee fee from Fannie or Freddie or FHA or VA or USDA. And it basically came down to two conditions. Now, people will come back at me and say, "Oh, there's so much more," but I can make the argument that it all comes back to two things. It comes back to the debt associated with the borrower. Actually, QM mortgages, you have to be below a 43 DTI. And then it comes down to how you actually verify someone's income. So it's not a hard, fast rule that you can't be a W-2 employee and get a QM mortgage, but it greatly, greatly, greatly increases your chance of being approved for a QM mortgage if you have a W-2 that corroborates that you could pay for the mortgage that you're about to get approved for.